if we're trying to educate the public about being a savvy, consumer and being able to, be a better buyer, if you will, right? Are they going to get a different rate going to a broker versus a mortgage bank versus a retail outlet?
I'd love to get Sean's take.
This topic is interesting just because the answer is yes and no. So any rate at any time is available to a consumer.
Uh-huh.
Okay. So you can go right now, say the average rate's like 7%, right? In general, right? Don't quote me on that APR. I'm not quoting a rate right now, but in general, say it's a 7% is being offered. That rate you can get at Wells Fargo. If you walk into Wells Fargo, you can get that rate. If you walk into a credit union, you can call a mortgage broker, you can get that rate, or you can call like a retail lender, like where I work, and get a 7%. The difference is going to be the cost to get that interest rate, if there is a cost. So I think the biggest thing for a consumer, just to like simplify it, is at any time you can get any rate. It's just what's that going to cost, or on the flip side, is there even going to be a cost? Because when refinances were popular, the term no cost refinancing was, hey, well, I got a letter in the mail. It's not going to cost me anything to refinance. And that's technically not true. What they're doing to kind of, highlight what Ben was saying is they're just going with a little higher interest rate to offset having to charge an origination or a discount point.
So they're taking what the overage used to be, basically, right, and applying it towards the cost, the hard cost of originating the loan, so that the consumer doesn't have to pay the hard cost. So they're passing through what they used to keep as a commission, right? And the consumer can benefit from that, but it's not truly free. You could have gotten, if you looked at the rates in a savvy manner, you might have actually been able to get a lower rate. So you could have paid a cost, but got a better rate, which may or may not be beneficial. Right.
Yeah. And then that just goes into the whole overview of like, is it worth buying points? Right. And that's like a whole discussion we can have too. Is the lower rate more important, or is it better benefit them financially?
I would love to have that conversation. So, I don't know everything about mortgages. I'm not a mortgage lender. But I know how bonds work and are priced. So when I bought my mortgage, I got my mortgage, a couple of years back, I'd gotten I was approved at a 3.5, and a couple of days before closing I was just telling Ben about this on the car right over here. Talked to him a couple of days before closing, and I could go from a 3.5 to 3.65, an extra eighth. And I got just over $9,000 lender credit that I then used to apply towards my closing costs of originating the loan and my other costs associated with the purchase. Right. And that was on a VA loan. So I bought my house literally $0 at closing. Right. It was awesome. And then I did end up refinancing a couple months later, and it turned out great. But what does that look like if somebody goes, because now we're in a way different environment than we were in 2019. So points, because there's all this stuff out there about, you're buying a home and the builder will give you a credit or a rate buy down and do that. But it's just a cost. So if you want, how is that priced?
Just moving the numbers around, right? I'll give you an example. 2022 and earlier into my career, it was very common to hear the word premium price. Premium price means there's no origination charges or discount, no points being charged. In fact, we're quoting an interest rate a little bit higher to help give that credit back to the consumer. So we'd premium price alone, trying to make it really economical on the closing cost side. Maybe I'm going to deviate from answering your question with kind of giving a little bit of an analogy. I tell a lot of my clients that I'm going to give you a menu of options, a menu of interest rates, and a menu of the associated closing costs that go with it.
Yeah.
But picture it like a teeter-totter. Interest rates on one side, closing costs are on the other. And as you apply pressure on one side of the teeter-totter, the other one's going to naturally come up. Mm-hmm. So it really comes down to, where do you think the market is going? Because if it was hindsight's 2020, if we knew exactly what the market was going to be doing in 6 months, a year, 2 years, 3 years down the road, we'd be able to package a perfect economical scenario on a loan. But I have found the majority of my career, I have premium priced, because let the market give you your discounts, right? Rather than paying for it. So that's the way I've always operated, is on the teeter-totter, I'm always looking at keeping the costs low and then explaining and showing the numbers on the rate.
Yeah.
Am I making sense when I picture it that way?
Yeah. For me, yeah. So for me, in my case, I felt like I'd rather have a 3.65, which is a little bit higher rate, an extra eighth of a point. But
here's where your consumer problem is. Loan officers aren't giving the options. They're not showing the menu. They're not saying, here's 4 or 5 different interest rates with the associated cost. They're quoting one interest rate with what they think is the best for the consumer. That's where I feel like the biggest gap in the industry is. Sean, what's your take on it?
Yeah, that's what I was going to say is, as a consumer, if someone's like watching this, I wouldn't necessarily, I would definitely recommend using like a mortgage expert, someone that's been doing it for a long time. I probably wouldn't recommend a credit union or a bank, just more so, especially on a purchase, the most important thing is getting the house and closing on time. And so with big banks and even with brokers, sometimes because they're not fulfilling the loan in-house, they're giving away that control. So I would, if a consumer's like, when they get so focused on rate and cost, I think sometimes they lose focus of what's the most important, because a mortgage company doesn't have to, if they give you a quote up front, they get a loan estimate and it's not locked, they can quote anything all day. They don't have to guarantee and fulfill that at the end. So that's another kind of common myth.
yeah.
There's nothing holding that mortgage company responsible for honoring what they, quoted to win the deal up front. So as a consumer, definitely focus on prioritizing, hey, who's going to guarantee or who's going to help me get the home, because that's the most important thing, right? How do I secure the asset, essentially? And then from there, like Ben's saying, is if the loan officer's not already doing it, that might be a red flag, but getting options within that, the same day pricing, because a lot of times consumers don't realize too, it's like tomorrow the market might be different and rates might be different. So
It'd be different later this afternoon.
it could be, intraday pricing could change. So, but to simplify it, get the different options. And then between the different options, it's, hey, what's the interest rate? What does my payment look like? And then what's the cost involved?
And find your break even.
And then from there, it's, hey, because I'm going to have this loan for X amount of time, depending on the client's goals, are they going to be in the home 3 years, 5 years, 10 years? It's more of like almost like a financial planning question, and like doing a deep dive on, hey, what's the family's goals with the home, with the asset? And then from there, it's, hey, which one meets that goal best? And it doesn't make sense to pay $10,000 more at closing.
But what you're describing right there is finding a loan officer that wants to build a relationship with you and map out a plan for not only this transaction, but your future, right?
100%.
And not transactional. And how many loan officers that work for credit unions, banks, or even mortgage companies, most of them are transactional.
Well, I'm not a mortgage loan officer, and I have these conversations with clients as a financial planner. When I have clients that are savvy enough to remember to call ahead of decisions like this, and let's talk through this. And we try to map out exactly what you said, Sean, which is, how long are you realistically going to live here? Because an investment property is an entirely different conversation than getting a larger primary residence because kids are growing up, right? And then the future downsize plays into that, and and whatever somebody's goals are. But mapping out how long you're going to own the home for. I think in simplified down, what you're saying is, and I don't know what the pricing on the back end looks like right now in the market exactly, but if you're going to originate a loan and to have it go from as an example, like a 7% interest rate to a 6% interest rate, because for whatever reason you feel like emotionally that's what you need to have, and that's going to cost $30,000, right? Like it's going to be an expensive buy down.
Yeah.
But you're saying, well, the seller was going to give me a credit, so they're going to pay for it. So I don't have to pull like $30,000 out of my checking account. It's just going to be a credit that's going to be applied. The bank will get that $30,000 basically, And that offsets them having basically a subpar bond now that they have to try to sell. And all you're saying is, look at that 30,000. If the difference in the 1% of the interest rate is going to save you $10,000 in interest over the next 5 years you intend to have the home, don't spend $30,000 to save $10,000.
Stepping over $1 to pick up a dime.
It's just that. It is that simple, right?